Okay, so this is the presentation to the United Regional Chamber of Commerce. I am John Almeida from Marcum, and I'd like to give some tax tips for the 2021 filing season, some things that you can do before the year end, and some things to think about to save money on taxes.
Awesome.
And it's just what I'm going to go over, tax tips. I'm going to give you a little bit of information about some new things happening in Massachusetts this year, and a little bit of information about certain tax credits that may be of interest. So a little bit of information about me. I am with Marcum in Providence, and Marcum has offices around the country. We are in Providence and Boston, and myself, I am a resident of Attleboro, and locally I'm the treasurer of the Attleboro Land Trust, and we are dedicated to the preservation of land in the greater Attleboro area. And I am licensed as a CPA by the state of Rhode Island and the Commonwealth of Massachusetts. Also am a certified fraud examiner and accredited in business valuation. So this one really is not the one I wanted to start off with is not necessarily a tax planning tip for the end of the year, but I put it as the first slide because I believe it's one of the most important available to small business owners. And I know there are small business owners out there that have not taken advantage of this credit, and they may be eligible to do so. And it's a federal credit related to the business's payroll that could be eligible for up to $7,000 per employee per quarter in 2021 for the first 3 quarters. There are rules for filing, and the credit can be claimed by amending payroll tax filings for 2021 and also 2020. At the end, when I discuss credits, I'll get into this a little bit further, but it's the eligibility requirements, but it is very important to small businesses looking to recover from the pandemic. So, small business owner, the majority of small businesses out there use the cash method of accounting for tracking their income and expenses. And what is the cash method of accounting? Well, if I cut a check to a vendor and I date that check December 31, that's when I'm taking the deduction for it. And if I receive a payment from a customer and that payment comes into me before the end of the year, that is when I'm picking it up for taxable income purposes in that year. So there is the ability to either defer income or accelerate your expenses. Sometimes with deferring income, you do not have the flexibility. If a credit card payment coming in from a customer hits your account before the end of the year, there's no wiggle room to be able to defer that payment because the payment has hit your account. And this is talking about the cash method of accounting, that when you receive the money and when you pay out the money, that's the year that it's recorded in for tax purposes. So deferring income, if you are able to defer receiving payments from customers or collecting for products, then that is a way to defer into the following tax year. Accelerating expenses. This time of year, we're discussing with our clients, if you have any bills and you're on the cash basis, if your cash flow allows you to pay them down, get those bills paid down before the end of the year to get a tax deduction for it. Now, some people may not know that even if you pay your bills on the cash basis, credit cards are deductible in the year charged rather than when paid. So if I'm concerned about having the cash flow to pay out a particular expense before the end of the year to get a deduction, then I could charge that on a credit card and still get a deduction for it during the 2021 tax year, even though I'm a cash basis taxpayer. Now, on the accrual method taxpayers essentially report their income when it's earned and deduct their expenses when the obligation is incurred. So to keep it simple, when I've received an invoice for a service that a vendor has supplied to me, that's when I can deduct it. And when I bill a customer, that's when I'm required to report the income in the tax year. So if I have the ability to delay invoicing or shipping goods at the end of the year, then I can defer that income into the next tax year if I'm an accrual basis taxpayer. And if I incur the expense prior to the end of the year, I may have the ability, if I get my vendor to invoice me before the end of the year, I can pick up that as a deduction in the 2021 tax year. So it's all about finding ways to push income into the next year and accelerate expenses into the current year. Just the methodologies of doing that are different, whether you're cash method or accrual method. And some business owners may say, well, I'm not certain what I am. Well, if you're a sole proprietor on your personal income tax return, your Schedule C will tell you whether you're on the cash basis. If you are a S corporation or a partnership, those business returns will tell you, there'll be a box check to see whether you're an accrual basis or a cash basis. But hopefully you already have some idea of that. So some tips. Now, this employer-child isn't really necessarily an end of the year decision unless you're looking to give out some type of a bonus, but business owners or others who are self-employed can consider employing the children to work in their family business. And what happens there by employing the children is that you get the benefit of the income at the child's tax rate, and you get the benefit of the child filing a tax return and taking advantage of their own standard deduction to offset that income. And it's important to note that wages paid by sole proprietors to children under the age of 17 are exempt from Social Security and Medicare tax. So there's an option to save there as well on those taxes for sole proprietors by putting the child on the tax return. So the caveat here is to make sure that the wages paid are reasonable given the child's age and work skills. I have 2 10-year-old twins at home, and I would not be putting them on my payroll anytime soon. But it's something to consider for those that, of working age. So next one is claim a home office deduction. This is important to consider if a business owner, sole proprietor has not considered this, and to be aware of the option to take a standard deduction of $5 per square foot for the area of the home that's used for business purposes. And that is up to 300 square feet. So that's a maximum of $1,500 deduction. Now, the other way to do that is to actually measure the area of the home that's used for the business and deduct a percentage of the actual expenses of your home, utilities, property taxes, any of the expenses of operating the home that a portion of which relate to that area of your home that's used exclusively and primarily for your business purposes. Other words, an office in the home, that's distinct, separate area of the home used for business purposes. Business meals, it's important for business owners to note that even through next year, the deduction for your business meals, which existed this year as well, is 100% of the expense. So I go out and have a meeting with a prospect, and we go out to dinner, discuss business. I hang on to that receipt. And in the past, prior to December 31, 2020, those expenses I could only deduct 50% of. But temporarily, through January 1, 2023, that type of expense I can take 100% deduction for. So for the 2021 tax year, you want to be looking back at, what did I incur and, what can I deduct? Because I'm going to get 100% of that. And certainly going forward, that will hopefully increase your likelihood of incurring those types of expenses, because the whole idea of the adjustment to the rate was to help these restaurants that are hurting from the pandemic. Tracking mileage, this is one that could potentially go overlooked. That the standard mileage rate is 56 cents per mile for miles driven, and that 56 cents per mile, it can offset your income tax liability and may be more than the actual expenses of operating the vehicle multiplied by the business use percentage of the vehicle. So that's something you want to take a look at. If IRS is going to audit that, they'd want you to produce some type of contemporaneous log of your miles and to justify your business miles driven. And it's important to note that commuting miles do not count for purposes of this deduction. Next is acquiring assets. This is a very common discussion I have with my clients, is the strategy of if I'm planning some type of expansion and I need a piece of equipment for my business, well, it may behoove me to get that asset in place before the end of the year to push that transaction into 2021, because I know that there's this Section 179 expensing election out there where assets used in the business may qualify for 100% expensing through the end of the year, even though I may not have actually paid for the asset by the end of the year. Let's say I go and I buy a piece of equipment and I take out a loan to buy that piece of equipment. Even if I'm on a cash basis, if I've got the equipment in service at the end of the year, then I'm going to be able to take that 179 deduction, even though I may be paying off that piece of equipment over the next 5 years. So if I'm looking to offset some a windfall of income that I've got in 2021, and I'm planning to buy these assets anyways, I might try to get that in before the end of the year to derive the benefit, the current tax benefit of that expensing. And it can be significant. The maximum amount that can be expensed is 1.5 million. So there's not a lot of worry for the small business owner of exceeding the limit on expensing. Bonus depreciation is another methodology by which you can accelerate depreciation on certain assets. Unlike the Section 179, this can be utilized even if it throws your business into a loss. So, through December 2022, that bonus depreciation deduction is 100%. So there's potential expensing of the 100% of the value of the business assets placed in service in 2021, even though I could throw my business into a loss situation by taking that bonus depreciation. And it's important to note that some states may or may not conform with these provisions. So you may have a situation where you're eligible to take the deduction on your federal return, but there may be an add back at the state level, reducing that. Very important for the small business owner to know about the Section 199A deduction for sole proprietorships and owners of pass-through entities. And this is a byproduct of the Tax Cuts and Jobs Act, which was a trade-off to the reduction in the corporate tax rate that lowered it from 35% to 21%. So the concern was these large corporations were being taxed at 35%, and now they're being taxed at 21% as regular corporations, and that effectively reduced the benefits of the S corporation, because the S corporation, your profits on an S corporation and partnerships are taxed at the individual owner rates, which can go from 0 to 37%. So the trade-off and give the benefit to the small business owner was this 199A deduction. And it is a 25% of qualified business income. And I'm not going to get into all the permutations of how you get to the qualified business income, but generally it is equal to 20% of your income, and that's a deduction. So if I make $100,000 in a year through my business and I own the whole business, there's potentially this 20% deduction. So instead of paying tax on $100,000, I pay tax on $80,000. And it's subject to limitations that are wide and varied, may impact whether or not you have paid wages. There's a 50% wage limitation. There's a limitation on certain businesses that are called specified service businesses. Accountants are included in that the deduction may not be eligible to take depending upon your total taxable income. But this is something to be aware of, and certainly inquiring to your preparer as to whether you're not you're deemed eligible for it, and performing those calculations to get this deduction. This is very important, funding your retirement. Many small business owners overlook this aspect, as opposed to someone who may be a wage earner that signs up to participate in their employer's 401k plan. The business owner is really just thinking about, okay, how can I get as much money in my bottom line as possible? And then maybe only after the fact, thinking about how do I defer income for retirement in future years. So there are a number of vehicles available to be able to do that. One of the most common ones is the self-employed retirement plan. And that self-employed retirement plan for a sole proprietor can be 20% of the allowable maximum contribution is based on a function of your taxable income. And that can be 20% of your taxable income up to that you could make a contribution and reduce your bottom line subject to tax. That maximum contribution of $58,000 is an individual contribution limit, but there are limits that are also based on income. So if your bottom line is lower, then and that 20% comes in, then you may not be able to do it. Now up to the 58,000. Now for a S corporation, there is the contribution is a function of the payroll taken out of the entity as to how much you can contribute to the SEP. And you also have to be aware that if you're contributing a percentage for yourself, there's also a requirement to contribute on behalf of the employees. So that's a balance that you have to weigh as to how much you're giving a benefit to employees versus the amount you're saving in taxes. So that's something to discuss with your accountant as to how to maximize that, and also your investment advisor. So there's a number of options. The 401k, you really have to have in place by October, and to get the payroll deduction portion of it, which is the up to 19.5, you want to have that done during the year. There are discretionary contributions that can be made with a 401k plan that can be funded after the end of the year. But the SEP, there are a lot of business owners that are sole proprietors. They may have one or two employees and that might not work full time and may be eligible for a contribution, but it's not that great. But on the part of the employees, but the owner could get a substantial contribution. And that one, there's flexibility to fund that up to the date of filing of the tax return. So that's certainly one to look out for small business owners, that they can do after the end of the year and get beyond what's the traditional IRA maximum of funding $6,000 or $7,000, depending upon your age, to a traditional IRA. So some information that is new for Massachusetts in 2021. This was effective, signed by Governor Baker, effective 12/14/2021. And it essentially just extends what was already available for corporations to the individuals, as far as excluding from taxation the Paycheck Protection Program for Massachusetts taxation, idle advances, shuttered venue grants, restaurant revitalization fund grants, and other amounts received from small business relief administered through the Massachusetts Growth Capital Corporation. So this essentially created parity for individuals, meaning the sole proprietors, with corporate taxpayers. So it's important for the small business owner to know that all these items are not going to be taxable in the Commonwealth of Massachusetts. This one is very new for Massachusetts. Massachusetts was a little late to the game with some other states, particularly neighboring states of Connecticut and Rhode Island, in terms of trying to counteract the limitation on state and local income tax deductions for the individual. Currently, an individual for their federal income tax return is limited to an itemized deduction of $10,000 for state and local tax payments. And that extends itself to the income that's received from the business and the state income taxes that are paid on that business income. So if I'm trying to figure out what my itemized deductions are for the year, I know I've got potentially charitable contributions, I've got mortgage interest, and I've got state and local taxes. So I've got my property taxes that work towards this $10,000 limit. I've got my income taxes paid to the state, which work towards this $10,000 limit. And once I hit that limit, and many people with property taxes can get very close to that $10,000 limit or exceed it just on property taxes. So once you've hit that limit, you're not getting any additional benefit from the state taxes paid on your business income to Massachusetts. So you just cut that check and you don't get a federal income tax deduction because you already hit the $10,000 limit and you're stuck. So that's been the case since they lowered the limit to $10,000. Now, it started with Connecticut. Connecticut was the closest state that came up with this pass-through workaround, whereby entities that are called pass-through entities, whereby you have your S corporation, your partnership, and those entities pay taxes at the shareholder level, meaning the corporation doesn't pay the tax on the profits, but the owners of the shares of the business pay it personally on their personal income tax return. In Massachusetts, you're now permitted to elect to pay the tax at the entity level. So Connecticut got on the game very early. Rhode Island followed suit, and now Massachusetts is making this available to its taxpayers. And how it works is the pass-through entity, meaning the corporate entity, pays the tax on its share of the profits of the business, and it reduces the tax bottom line that shows up on the business income tax return for the federal government. So if I had a profit of $100,000 and I decide to go through this pass-through entity tax option, I could pay my 5% Massachusetts tax, and instead of paying tax on $100,000, I pay tax to the federal government on $95,000 because I was able to take a full deduction for the $5,000 instead of potentially losing some of it, taking it as a personal deduction. So it may sound confusing, but the bottom line is by having your pass-through entity, be it partnership or S corporation, pay that tax and pay it before the end of the year, you may get a federal tax deduction for the payment that you would otherwise potentially lose out on if you made those payments personally. So that's something that's really big for the small businesses that are organized as or paying taxes as partnerships or S corporations. It's important to note that the sole proprietorships and single member limited liability companies that are disregarded for federal income tax purposes do not have the benefit of making these tax payments because it's really a corporate level payment. So circling back to the employer retention tax credit that I mentioned initially. For 2020, this is a 50% credit based on eligible wages up to $10,000 per employee. So this could produce a maximum credit of $5,000 per employee for the tax year, which could refund both your payroll taxes and wages that were paid to those employees. And this credit is taken by filing an amended tax return for the year 2020 for the quarters in which you incurred the wages. Now, to qualify for this credit in 2020, you had to incur more than 50% reduction in gross receipts in a particular quarter versus the same quarter in 2019, or you were subject to a governmental restriction on your operations. Now, a perfect description, explanation on that governmental restriction is restaurants. Restaurants, even if they didn't have that 50% reduction, if they were under a restriction where they could say only operate at 25% capacity, or they could only have capacity up to 75%, until those restrictions were lifted by the Commonwealth, they would be eligible for every single quarter that those restrictions were in place for. So even if they didn't have the 50% reduction, they may be eligible. Now, moving forward into 2021, the credit got even juicier in that the credit is up to 70% of the wages. So potentially $7,000 on $10,000, but it's per quarter. So if I paid someone $10,000 in a quarter, I might be able to get a 70% credit for that quarter alone, never mind quarters 2 and 3. So, and that is also the reduction in gross receipts is actually not 50%. It's more than 20% reduction. So that's even easier to qualify for. And also the governmental restriction still exists. Now, with the latest tax legislation that came out, they restricted 2021 so that it's only eligible for the first 3 quarters, but it's still there for the first 3 quarters. So that's something that if, as a business owner, if you haven't looked into this, you really should look into it, because it's essentially money that covers your payroll. And it's important to note that it ends up effectively being taxable income, because if the government's paying your payroll or paying your taxes, they're not going to give you a deduction for that. So it's kind of an add back, but I'd rather take the money and pay the tax. Another credit that often gets overlooked by taxpayers because they think they're not eligible is the research and development tax credit. And how do you qualify for that for activities in your business? It's investing resources for new and improved products, investing to develop a new or improved manufacturing or service process. People think when they think about the research and development tax credit, oh, that's probably only eligible for companies like Pfizer, developing vaccines and investing money in that. But when you're refining or improving a process in your business, those activities could potentially be eligible for this credit. And it's something to consider and to discuss with your accountant. Every time I make a new widget, am I refining my processes to do that? And as such, is the wages I'm paying, is the investment in technology, is the subcontracted costs, could those potentially be eligible for this federal credit? So it's something to consider. And sometimes if it's really a large credit, you want to look into having a study done to substantiate that credit and defend it in the case of an audit. But the first step is to really start just even considering whether you potentially qualify for that credit. So I hope I've given you a few things to think about for the end of the year and tax planning. And if there are any questions from the group, I'd be happy to answer them now. My contact information is up on the screen. If someone wants to shoot me an email with a specific question or give me a call, then they're certainly welcome to reach out. Thank you.
Awesome job, John. Thank you very, very much. Hopefully that's going to give some good tips to some of our small businesses. And as John said, if you have any questions or concerns, shoot him an email, pick up the phone, give him a quick call. John is pretty easily accessible, and he'd be glad to answer your questions. And he'd also be glad to become your accountant if that's what you need for your business.
Well said, Jack. Can I ask a question now?
Yep, absolutely.
You talked about the SEP IRA, which I have, and then you talked about a 401k. Are you allowed to have both? I have a SEP and a Roth right now.
Well, oftentimes there are, you run into circumstances where you may be you may be running a small business and contributing to your SEP, and you may be in a situation where you are an employee and contributing to your 401k, and those circumstances are allowed if you're not exceeding that $58,000 limit. I did run into a circumstance recently where a business owner had a simple IRA and also a 401k, and in that case, you have to be mindful of the 401k limit on the contributions of the 19.5 or 26 if you're over age 50. But in the case of a SEP and a 401k, business owners are surprised to realize that they can contribute to both.
All right.
I have a couple questions, John. You talked about the 1099 and deferral of income. Or you talk about deferral of income, reporting income in the subsequent year. Mm-hmm. Client sends me a check this week, and I elect to deposit it week after next. It goes into next year's revenue because I'm a cash basis guy, right?
That's a very important question, and what your IRS agent will say as the standard is, I've got that check in my hand, it's taxable income in that year. Whether it doesn't, I don't make it to the bank until 2022, it's taxable income in 2021. However, did it come in 2021 or 2022?
Well, let's
there's some subjectivity there, and as an accountant, I would say if it's in your hand, it's income in that year, and that's when it should be. But as a practical matter, have businesses playing that float and putting it in the other year? I'm sure that it happens.
But you could very well be in a situation where the customer cuts the check and mails it on the 26th of December, and it doesn't even hit my hand, my mailbox, until the 3rd of January.
Right, and in that case, let me ask you. In that case, you haven't, even though the business paying you, is taking a deduction for it in 2021. If you haven't received it until 2022, then that's the year that it would show up in your income as a cash basis taxpayer.
Okay, now the other question that has always been of interest to me is, because of that kind of thing, 1099s don't always balance exactly, because that client is going to show that payment to me on December 27th as a this year 2021 expense. I'm going to take the revenue in 2022. Have you ever run into a situation where that was a problem?
Mm-hmm. Yep. And there's a couple of ways to deal with that on the personal income tax return. One is to show the actual amount of the 1099 amounts on your personal income tax return. So there's a matching and you don't get a notice that say, okay, you didn't pick up this 1099 and have to deal with the notice, by making an adjustment on the tax return to adjust it to the cash basis separately from the amount that's on the 1099, so that you're picking up the exact 1099 amounts. Otherwise, you may have to deal with the notice and explain to, the 1099 was produced at this amount, but my receipts indicate I didn't receive that until the following tax year. But there's a way to deal with that, so in the preparation of your return, that you don't get a notice.
Gotcha. Thank you.
The IRS will generate the automated notices just based on a matching of what's in your return and what they received for 1099s.
the other timing question, it was sort of news to me that credit card expenses are deductible in the year in which incurred as opposed to paid. Cash basis accountant here has always figured when I write the check to pay that bill, that's when the expenses are deductible. Is that an issue that I should be concerned about?
Well,
it seems to me if the IRS isn't going to be interested in me accelerating that deduction into a prior year, but should I be concerned about it?
Yeah, I mean, you do have a timing issue, but maybe the timing issue is not that substantial when you total up your payments for the entire year versus your charges for the entire year.
Yeah.
There are businesses that are doing it the way you say based upon when it's paid, but the theory in with the credit card charge is you've basically incurred a loan at that point, the moment you charge it. Yep. So that's allowable for it's the same as with the example I said where you buy a piece of equipment and you take out a loan to purchase that piece of equipment. When it's charged is when it's eligible. Like I said, if you totaled up all your charges for the 2021 tax year and compared it to your payments, and your payments were much, much more than your charges because you're paying off charges from a prior year, could it be an issue under audit? Possibly. What an agent's going to do is they're not only going to look to, they're certainly not going to exclusively, you're not just going to hand them your credit card statement and say, I had a charge. They're going to want to see the invoice that shows that, yes, it was a business expense and it was business related, because the credit card statement isn't going to give them enough information to make that determination. Right. So under audit, I've had circumstances where the client just tries to hand them the credit card statement and say, yeah, these are my charges.
Yeah, right.
There's not enough information on there to determine it's a business expense. So they'll default back to the invoices to support your payments. But the charge can count.
Gotcha. Thank you. I think that was those are the only things I came up with. I'm going to check on the home office deduction situation to make sure that I'm doing that to my best advantage. Appreciate it, John. Very informative discussion and presentation. Well done. I hope that you get a lot of traffic online through Jack's alignments, and it works out well for you. Appreciate your time and effort you put into it. Great presentation.
Awesome.
Can I ask one quick question before we wrap up?
Sure. All right, great. Well, again, John, thank you very much for your time and your expertise today. We have recorded this, so it will be produced out on AACS in Attleboro. The crew over there has been really good to us. But again, thank you. And if I don't see any of you, happy, merry, and hope everybody stays safe.